They have no reason to be safe with your money. Why not? Because you can privatize the gains. If they win big. If they lose, they get the taxpayers to pay for it. It has been a wild couple days because there has been bank after bank collapsing, and we're worried about these dominoes all falling and taking down all of the banks. So the flagship that everybody is talking about is SVB, and we want to know, will we be covered if the bank collapses, and what will it be? So if we take a look, Silicon Valley Bank collapse, this is what made all the news. The second largest bank failure in US history, around $200 billion. Now, you would say, does that just stay in California? Absolutely not. It took out Israel's banks, it took out the UK banks. We made another video about that and we'll post it just below. In Canada, where I am, it erased $20 billion worth of value out of Scotiabank, BMO, and TD, and their stocks were falling because of it. Now, are we covered? Now, this is in Canada. We have CDIC, and we're going to be covering the US one as well. If we look at the Canadian one, Canadian Deposit Insurance Corporation, if you check that out, you are covered up to $100,000 in your name. It doesn't matter if you are a joint with your wife. Well, it's still going to be the same 100 grand, but you're allowed to have money in trust in a different account. You're allowed to have a TFSA in another account for 100,000, another 100,000 for retirement incomes. If you have any RIFs, those are 100,000. Education, RESPs, 100,000. Or if you have a person with a disability and you're saving with that, RDSPs, you can have 100,000. So for each person, you can have $100,000 in each one of these accounts. But notice, in each of your branches. So what should that teach you in this instance? This should teach you that if you have more than that, you need to be having it into other banks. You need to do that. Very, very, very important. So if you're over those limits, please put your money in other banks. You are not covered. Now, if we go into the United States has the FDIC, very, very similar. But what they allow in their accounts, checking accounts, savings accounts, money market accounts, they have CDs there, bond stocks, mutual crypto, all of it. It's $250,000 per depositor, per insured bank for each ownership category. So 250. So it could be 250, 250, 250, 250. Okay. But if you're over that, that's where you're going to be in trouble. So, you know what? 90% of us, this is not us. Okay. That we're not going to be landing in those positions where we're way, way, way over. But it could be. And if it's you, wouldn't you like to have your money saved for you? Now, why did that bank go down? Now, I'm going to tell you, the banks just went down like that because they weren't paying attention. And some would say you're deliberately doing it. So for me, there's only two answers here. Either you were negligent, to which you shouldn't have had that job. You should not have. Or you were malicious and you did it deliberately. Either way. So imagine right now for one moment, you had this. 50% of your clients, 50% had less than $250,000 in your account. Okay. So just regular working people, 50% of your total business for your bank was less, but 50% was more than 250,000. That's in the States, right? So in Canada, we would just say that would be 100,000. But if this was the case, 50-50, this is low risk. So it's all insured. The bank is safe, but this stuff is risky. This stuff over here, very, very risky. So if we take this Silicon Valley Bank, guess what they were at? They were at 90% over 250,000. Full risk on, zero regard for what is happening, only 10% safe over here, less than their 250,000. They had it coming. They were asking for it. But for some reason, the giant banks, the biggest banks that are out there, all have to go by this rule up here. They all have stricter rules to keep you safe. So where should your money be? Your money should be with the bigger banks that have even more regulations on them, maybe not some of the smaller banks if you have larger sums. Now, it's good to know that you're insured, but we can't let banks just go out, be negligent with the money, because what happens if they do? There's this wheel and it's called moral hazard. Have you ever heard of that before? Moral hazard. What happens is if the bank will make a lot of risk, and if they win, they win. If they lose, what do? They ask the government for a bailout of some kind. They ask for a bailout. And then if they get a bailout, guess what happens? They get taken out. And what happens? Even more risk. And then it just goes around in circles over and over and over again because they have no moral hazard. They have no reason to be safe with your money. Why not? Because you can privatize the gains. If they win big. And if they lose, they get the taxpayers to pay for it. That's not fair. That's not fair to regular guys like me and you. And the governments don't have like billions of dollars just lying around for no apparent reason in case. They have to print that money some way, somehow. They have to get it. And it's either through taxes or printing. Printing is that invisible tax on inflation tax. And so no matter what, your inflation has got to go up, unfortunately. So this is where we have to make sure that we're paying attention. But do you remember the government gave $25 billion, $25 billion in cash to SVB. Unbelievable. Where do you think they came up with that 25 billion? Now they had to take away from them $25 billion in toxic mortgage-backed securities. You guys must be thinking this is like 2009, 2010 all over again, right? And it sure feels like that. So they tried to stand firm on Saturday and they said, absolutely not. No bailout, period. But they had to spend Sunday concocting some kind of really good line, really good reason. We're doing it for national security, right? To come up with something, because before the Asian markets opened, the stock market would have absolutely tanked. Now, they're only 200 billion. So don't think about it just losing 200 billion. You may have a $10 billion company with $1 billion in that bank. And if they lost the 1 billion, they're out. They're not going to be able to survive without that. So even though the bank lost $1 billion, it may take down a $10 billion company. So a $200 billion bank could take down trillions of dollars of economic damage on the way down. And they were known for not only just their wineries, for example, or their almond farms, but biotech and all the tech ventures that are out there. Remember the list that we saw between Dropbox and DoorDash and Roku and Airbnb, and they all had their money there. Imagine all of those companies just disappearing overnight. I can't imagine the contagion. So the government was forced to take action. But I'm wondering, do you think that was the right action to take? To spend that money, to spend the taxpayers' money. Again, that moral hazard keeps on coming back. And this is just seems a lot like deja vu. We expect some massive inflation coming in the future over the next 5 years, but there's going to be a big recession, a hard landing. I can't see this whole no landing business. I've been saying that we've been in a recession for the past year. How else can you look at it when homes on average in Toronto have lost $500,000 each? Unbelievable times that we are living in, my friends. Stay safe.